Hi everyone, this is Jenn Appel speaking, and thanks for tuning into Topic Talks. This quarter, we're going to be talking about the labor market, and there's currently a lot of focus on macroeconomic data in terms of both growth and inflation dynamics, which are going to continue to influence the labor market. But we wanted to highlight some of the data and provide some thoughts on the environment and some potential impacts going forward. So to start, headline labor market data improved at a rapid pace following the disruption associated with the COVID-19 pandemic. At the peak in Q2 of 2020, the U3 unemployment rate hit 14.7%. And now, about 2 years later, that rate is at 3.6%. And you can see a pretty similar pattern in the U6 unemployment rate as well, which is a broader unemployment metric that also includes the underemployed, those marginally attached to the workforce, and those that are discouraged or have given up looking for work. But really, regardless of the metric, this labor market recovery was historic in many ways. And notably, this was a faster recovery than any previous recovery in modern history. And today we're sitting with a very low headline number, showing that we have this robust and tight labor market, which has been the cause of rising wage pressures recently, given the demand for labor. That being said, there's a bit of variation in underlying data, whether you're looking at the industry level or different geographies, for example. There are still some gaps, for lack of a better term, and you can see that pretty acutely with the variation among the unemployment rate for different states. Perhaps this is due to a shift toward remote work environments, or even the sector composition of each state's economy and the job prospects associated with that. But if this turns out to be more of a fundamental change from a geographical standpoint, especially with the remote work environment, that creates a lot of questions. Will this impact the tax revenue from consumers, or excuse me, from commuters and residential or even commercial real estate? How does this impact small businesses like restaurants or coffee shops that were located near formerly densely populated office buildings? And what about the effect on climate change if we have enough people that are no longer commuting to work? So we have to acknowledge that this could be the start of all these potentially significant shifts. Now, kind of taking a step back, when we talk about the labor force, we're really talking about the people in blue on this slide, those that are working full or part-time, or even those that are actively looking for work. That currently represents about 62% of the population, and the other 38% is comprised largely of the share of the population that is 65 or older. That cohort has been growing in recent years, given the demographic profile of the US population, which reinforces kind of some of the deflationary bias in the current workforce. But as more experienced labor exits the workforce, those individuals tend to have higher salaries, but they are generally more skilled on average than an entry-level worker. So that can have a greater productivity hit as well. And ultimately, that shrinking labor pool can drag on economic growth. But the hope is that technology, for example, can boost future productivity and offset some of the wage increases we're seeing so that the per unit labor costs don't get pushed too out of whack. Now, an important labor market metric is called the labor force participation rate, or LFPR. This statistic represents the percentage of the working age population that is employed or unemployed but looking for work. We're currently sitting with the LFPR at 62.2%, which has recovered from the low point following the pandemic, but we're still quite a bit away from pre-pandemic levels, as a lot of folks have exited the workforce over the last few years. But really, that's a trend we've experienced over the last few decades, which we'll talk about some of the reasons why shortly. And this matters for the economy, since the growth in the labor force participation rate generally tracks with the growth of GDP, since it measures the workers that are contributing to the output of goods and services for an economy. So as you see the LFPR falling, that's generally thought to be a negative for an economy. And specifically today, with the labor shortage that exists, this has really fed into some of the supply chain and transportation bottlenecks, and ultimately the inflation narrative, since there are fewer workers. And I do think it's important to highlight that certainly this trend was disrupted in 2020, but we have been on a structural decline, most acutely in the post-2007-2008 time period. So while the pandemic exaggerated some of these issues, there's a lot more at play here. And as we look to some of the underlying LFPR data, this highlights a lot of the differences among various pools of labor. I'm not going to go too far in the weeds here because there are a lot of different ways that you can look at this data, whether it's by gender or race or some of the other categories we have here. But keep in mind that there are a lot of underlying societal factors influencing this as well. In particular, I think the age numbers here are quite interesting. You can see pretty big differences between the youngest workers, prime age workers, and those that are 55 plus. And as we look to the youngest cohort, there's been a large decline post 2008, which, this could be due to more people enrolling in continued education programs, or maybe it's due to the heightened demand for lower skilled or entry level jobs, since you can see a similar pattern with the education levels as well. But that's quite different than the 55 plus age group, where the participation rate is higher relative to that long-term average, which could be due maybe to better healthcare, greater longevity, or even changes in the retirement age for Social Security. But there are some really fascinating dynamics to dive into here. So with that in mind, still the headline number has been on a structural decline. So what's been driving that? There are frankly a lot of factors, both cyclical and secular, potentially at play. I've already mentioned that the aging population is likely one of the biggest influences here. Some estimates even suggest that demographics alone represent about half the decline we've seen in the LFPR as more of the population reaches that retirement age. But there are a number of other influential factors as well. Immigration policies, for example, impact the country's demographic profile too, since most immigrants are in the prime working age. So more restrictive immigration policies can continue to limit the labor force growth going forward as well. And I mentioned that we've seen folks leaving the labor force for a variety of reasons over the last few years. And that's really been one of the more puzzling aspects of this. But during the pandemic, many women in particular left the workforce as a result of childcare options being restricted. Given the significant rise in costs for childcare, among other things, we could continue to see folks leaving the workforce to become stay-at-home parents if the opportunity cost is so high otherwise. Now, all that is to say, if we continue to see these trends going forward, that may mean the demand for labor will remain strong and potentially it can support future wage gains. But there's also a negative economic consequence to this too. We can see lower economic growth rates given the impact on production and aggregate spending. So this will be a priority for policymakers going forward. So turning to today's economy, we are sitting with a historically tight labor market. One of the ways to measure that is with the labor market differential, which represents the percentage of survey respondents who say jobs are plentiful, less those who say jobs are hard to get. Now, this metric tends to be highly inversely correlated with the unemployment rate. So looking at today, we can see that even before the pandemic, there was a relatively tight labor market. Certainly a lot of disruption in 2020 and 2021, but we're back on the trend line. So why does that matter? Well, this is a good predictor of wage growth, and the higher this reading gets, the more plentiful jobs are, and that likely means wage gains will continue. And we've already seen really large wage gains across the economy. We're just showing the overall wage growth number here, but this dynamic holds true for nearly every part of the labor market. And since there's such a demand for labor, there are plenty of anecdotes that show employers are having to be more flexible in hiring, whether that's with wages, schedules, benefits, or anything else to help attract talent. And this kind of gets back to that idea in macroeconomics of the Phillips curve, which suggests that wages tend to rise faster when unemployment is low. And there certainly appears to be an inflationary bias with unemployment below 4%, as we can see today. Now, the concerning aspect here is that even as nominal wages have risen, with general inflation metrics being so elevated, real wage growth isn't keeping pace. And if we continue on this track, the concern becomes that we're going to end up in some type of wage price spiral where price increases result from higher wages. But fortunately, market inflation expectations have tempered over a 5+ year time horizon. So to conclude, the labor market has recovered significantly since the 2020 recession, but the LFPR suggests that there's something really confounding happening beneath the surface, which has reinforced a lot of the inflationary pressures that we're seeing today, particularly from a wage standpoint. And the dynamics that we're currently seeing will have long-term influences for the economy, especially from a growth and inflation standpoint. Should we see a more structural impairment in the LFPR, that has a lot of ramifications from a political standpoint, for socioeconomic dynamics, and especially for inflation, since that can push inflation risks to the upside. So we really need to be mindful of these potential impacts going forward. And with that, I'm going to conclude this episode of Topic Talks. Thank you for listening, and we hope you'll tune in next quarter. Thanks.